The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional advisor. I'm Dollar Will. Let's make some money. Give me a second, fam. Get the charts together. God, excuse me yawning. It's kind of late. This is a lot of work for traders. Going through this. Okay. Let's see. Where do I want to start? Damn, that's ugly. Okay. I guess we start at the beginning. The thing that matters most to most people, the S&P 500. It's your retirement account. That's if people if retirement is still going to exist. I tell you, when I started trading, I think I was around 23 to 25, probably more like 25 when I really kind of got serious. So we're talking, it'll be about 31 years this year. Okay. I've never seen this. I've never seen a determined selling like this. This is a weekly chart. In fact, you can look back in the past, just kind of scroll. Yeah, you see selling, but not determined like this. You look at other times, kind of orderly. This was the 07, still kind of orderly. You don't see those gaps. You don't see like a needle heading straight down. I've never seen anything like this. And I can't get it that, I watch these financial programs and people say, well, if you're young, you got 20 years, you should just forget about it. Well, wait a minute. I got a right to get rich young. I got a right to avoid working until I'm an old man. What if I want to retire young? That's my right to pursue that, or that's your right. I'm not that young demographic, but I, that wouldn't fly well with me if I was young for any financial person to tell me that it is acceptable for me to watch my retirement account get destroyed like this, and to have them say to me that I should look for the dips and bargains when I see volume of determined sellers. This is the largest. These are whales selling like this. Okay, the largest money managers on earth with the largest amount of money on earth, with the most knowledge, resources, and information at their disposal on earth. They're selling, but I shouldn't, or you shouldn't. That listen, take names of who's telling you what on TV, okay? Because it's times like this where you come to terms with who you really should trust when you listen to these people on television. Make them earn your respect. Don't just give them your respect because they're on television with a nice suit on, you know. All right, so this is the ETF SPY, which represents the S&P 500, and your most retirement accounts. I would say essentially all of them, because you don't really have many options in your retirement account. Either you're invested in the S&P 500 or you're in a bond fund. Hold on for a second. Oh, excuse me. I need a cough button. What was I saying? Yeah, so everyone is affected by this. Okay. Now, technically, we're kind of in. I never lived through a correction of this scale. There is a chart time frame. It's on the first video in my channel. It's a chart time frame that's going back actually before the quote Great Depression era. And according to Elliott wave theory, this particular high projects out to I think it's called the grand super cycle, you know. And so my very first channel video was about that correction on a grand super cycle scale. And that's my middle finger up in the air to everybody who says you can't time the markets. Okay, you can't time the markets does not mean you can't get the exact high. Nobody said we could get the exact high. But you can project trouble areas where something I'm gonna say catastrophic, where a large decline is likely, you know, and necessary. Actually, likely and necessary. Okay. So in that first video, it proved that technical analysis works, and Elliott wave theory is useful. And with that said, this particular degree of pullback, I've never lived through anything like this. So it's stressful even when you're making money. Now I'm shorting this market. So this is like the greatest time from a financial gain standpoint. It's like the greatest trade of my life. Okay, so it's working, and you know, I got a few people on my Patreon that have stepped up, and they're in some of these risky things too. A part of what's scary about it is the size of this downturn. At some point on this way down, we're going to hit a technical level where we have to give back some of this money. So I spend my day kind of trying to project where this bottom might hit. Okay. And so what you see here are lines that represent support levels. And so when the price breaks through a long channel, like in this case, when it breaks below that, you get a pretty significant decline. Now, I didn't think that it would go through this support and completely. Now this particular channel had been running since Christmas Eve of 2018. Okay, so this channel ran for over a year. You know, I guess about 14 months. I didn't expect it to just completely ignore it and just come like it wasn't even there. You know, on the weekly chart it did, and then came back and retested it, slapped the backboard, and kept on dribbling. Now, I definitely didn't expect this particular. Now, this is the one that's trouble. This one here. This diagonal line support here. Because this diagonal line support is the one that started the trend in 2009, where we made this historic bull run from 2009 to this point. Well, we're at that one now, and it broke that one. Okay, so how far this thing is going to go down, I'm suspecting, and we're about to make a lower low relative to this Christmas Eve of 2018. So all of these are technical alarms that cause automated trading systems to just sell. Now, a lot of traders, especially big money managers, they want to take human emotion out of some of their trades, because if you can sit there and overthink a situation, and once you see price, people that were solidly bullish start to get out the market, you have these support levels there. They're there to let you know that there's no more confidence in this run. And so as to protect yourself from yourself, they use, I guess they call it non-discretionary trading. They want to take human consideration out of it, because we have the tendency to get into paralysis of analysis at the time when we're supposed to be hitting the sell button. So a lot of these money managers use some form of automation to help them. Of course, they're in control of it. They program it. But when the moment of truth comes, the computer will make the quick decision to stop us from analysis, paralysis of analysis. And so when it crosses through these broken supports, that's how you get in these big candlesticks. This is a whole lot of computers pressing the sell button or triggering the sell button. And we're coming up on another big one. So this is a weekly chart. Tomorrow is Friday. I remember telling my Patreon people earlier in the week. Well, I talk a lot about market psychology, and one of the things that's common in, let's say, in bull markets, when you're on the greed side of the scale, as you approach a weekend, you want to leave your money in the market, because in uptrends, the price opens up. You're afraid that it might open up higher on a Monday, and you don't want to miss it. While in downtrends, it's the reverse. You're afraid of what will happen over the weekend. If you remember this past Monday, the market dropped 2,000 points before 9:30. So the market doesn't even open until 9:30. But the futures market showed a price drop of 2,000 points before 9:30. So when the opening bell rang, it was already down. Price was already down 2,000 points. And that was just this past weekend. So what do you think the odds are that the market will be up tomorrow and people will feel comfortable about leaving their money in over the weekend after that 2,000 point drop last Friday to Monday? I say that's pretty much zero chance. So tomorrow it's going to be especially ugly. But the good news is we're near a point where this market is due for a little pullback. Okay. But I don't think we're going to get it until we break below this point right here. And that could happen tomorrow. That could happen tomorrow. So this is just where we technical traders, we just kind of sitting on our hands. If you already taken your position, you're just kind of sitting on your hands and trying to not be too greedy, because one of these pullbacks, I don't want to give none of it back. I have to make up my mind. Am I going to sit in it, or am I going to get out? Get out and let it have a pullback and get back in. I don't know. I'm kind of thinking that right now I reserve the right to change my mind. Of course, it's my money. I'm kind of thinking I might just leave it alone, because if we could get a run up in the first, say, 3 days, first part of next week, and today being the 13th, okay, and Oh, another thing that's technical thing. March is the end of the first quarter of the year. And there's this Wall Street, I guess, trick, a little deceptive thing. They call it pain. And that is at the end of the month or at the end of the quarter, whatever was making money, they, meaning your mutual fund managers, they make sure that your fund owns the things that were making money during that quarter. And so then when you, so because whatever that fund is holding on the last day of the quarter, and that would be the last day of March, last trading day of March, whatever is in that fund at the end of that day, that's what shows up in your statement when you get your statement from your retirement uh, company, a fund manager. Um, it's going to show what you own, but the trick of it is but you're going to look at your balance, and you're going to, like, you might see, for example, like a big loss, financial loss, and you're gonna know that, okay, these things went up during those during that quarter, and you'll look and see, well, what the heck do I own? And then you'll see it might show that you own the thing that went up. So you'll be like, well, how is it that I lost money if I owned that particular stock and it went up? Well, the fact of the matter is you didn't own that stock for the balance of that quarter. You owned the garbage that went down. They, quote, painted the tape because they went in at the end of the quarter and put you in the stuff that was winning to, somewhat disguise, or at least make themselves look responsible that they put you in winning stuff. So there's going to be a lot of painting of the tape, and as we get towards the end of this month. So this is going to be ugly. And then once you get out of March, they have a whole nother quarter to move your money around within that account without having to report every little thing to you. So it could be ugly. So that's my downside, folks. That's the argument against me messing with this short and just leaving it alone. Maybe putting a trend line on it, and as long as that structure holds, if it making lower lows, just leave it alone. But I watch this every day. Okay. So there's some risky ETFs that rise. And so when I say I'm shorting it, the way that people short this is they buy these inverse ETFs. I really don't recommend folks do this, but this is for educational purposes. I'm telling you this just so you know that not everyone is losing money. Okay. So this one, okay, just to show you the bad side. When the market was winning, when the S&P was going up, look at this thing. It just got destroyed. This thing just got murdered. Okay. Don't even look. This price is up, I don't know, 27 million or whatever. I don't think it's going to get up there. Of course not. It's just ridiculous. So this thing got completely destroyed. So you got to have a pretty strong set of what to come in and buy this thing after it's just got destroyed like this. Okay. But this is one of the lottery video that I put up. I've done several videos of this, and I said at some point when this market falls, this is going to be where one of the places people are going to go. So at some point, this thing finally stopped falling around $38, and the price was this low here. $38 on February the 20th. And this high is $419. So to go from $38 to $419, okay, 380 something would be 1,000%. So It's not even March 20th. So in about 3 weeks, this thing has already made over 1,000%. And you see it, who knows how high this thing gonna go. But the scary part is this thing, when the market has its recoil and starts going up, this thing is going to come down fast too. It's just scary. So this is definitely for couch money. You don't, especially if you don't know how to trade. This is not something that you just put money in and walk away and be haphazard about it. But just to make the point that not everybody is losing. People making fast money. There's a show on CNBC called Fast Money. Let me see if anybody's what the stats look like. I put a StreamYard link over there at the top if anybody is even up right now. Why am I up? I'm a trader. The London Forex market opens, at 3. So I gotta be there. So let's see. That's one of the things I want to talk about, the S&P. Let me see what else. I think I covered that. Give me a moment. Look, see what else I'm supposed to be talking about. Again, forgive me for dragging. Life of a trader. Might be up for the London market. I'll probably fall asleep maybe about 5 o'clock, and then I'll be up probably by 8 to see what's up with the stock market. Oh, I know. I want to talk about. Let me look at the dollar. Let me just glance at that. Okay. So yeah, the dollar was diving real good, and you can see that, put an imaginary line here. It broke. It's going up. So a lot of currencies around the world, when you have crisis like this, a lot of what's up, Maddox 12? What's up, brother? Haven't seen you in a while. What's up, James Lewis? Yeah, but a lot of currencies in other countries, when you have instability like this, they don't trust their own money. So they get out of their currency and come to the US dollar. So you're going to see this dollar start to rise. And that's going to cause some stress in gold. So it's pretty severe move for the dollar. But the dollar made let me give you a bigger view so you can get the context. Let's see. Show you the line chart version. All right, so this is way, way, way back when we came off the gold standard, okay? And so the dollar really is made to go down. It pretty much is. That's what it does, is pretty much going down to this death spiral. But you have some occasional periods where it rises. And we're in one of those periods, like here and like here. We're in another one here. And we've been in this rise since 2011. It's just that for most of it, we were going sideways, and it's about to finish going higher. And that's what's scaring the hell out of a lot of foreign currencies, okay? And so the euro is going to be crushed. The Swiss franc is going to be crushed. The British pound is going to be crushed. Oil is going to get crushed. Cryptocurrencies are going to get crushed. Okay, the dollar is king right now, despite this low point right here. Now, we had a low here in February of 2018. And you see this, look at this value here. It says 91.88. Now, but last week or whatever, we had a low of 91.82. So this low is not lower. We have what's called a double bottom. So technically that, and you have this big volume spike here. That's like a washout. That's like all of the people who wanted to sell got out. Okay. So this is a monthly chart we're looking at. Let me go back down to daily. So we had this bottom on, my eyes are going bad, the 9th, and today is the 13th. So that's just 4 days ago. Why not just count the daggone candlestick? Each one of these is a day. I tell you, I'm losing it. All right. So yeah, so it's all about the dollar rise. All right. And there's this story about that gold is safe. Let's take a look at that. Y'all know I don't believe that because it doesn't work that way. Gold and the dollar have an inverse or opposite kind of correlation. Okay. When one goes up, the other goes down. Most of the time, there are some slight exceptions to that rule. Okay. Now, I thought this was the top. This nasty dip happened, but it didn't change the structure because it didn't make a lower low. It went low, but didn't go lower than this. So the upturn was still intact, and it came on up and made a higher high right here. So it made the higher, the price high was reached on March 9th, same day as that dollar low. Okay. And then this happened, and let's see what this low price is here. I'm looking right here. 147.05. And let's look at the candlestick for today. 146. Okay, this says 147.05. It says 146. So this is a technical alarm. We made a lower low. That says that this trend is likely over. Okay, and it broke this support as well. Now the question is it going to break this support, which correlates with this trend that started in it looks like August of 2018. Okay, because that would put, let's see, the high in gold was all the way here in August of 2011. If these supports start to break over here, then this low gets it could be under attack as the dollar marches higher, and the dollar has significantly higher to go. Okay, significantly higher. And on the big time frame of the monthly chart, the momentum indicator is flipped negative, so it could fall. We're likely to come down in this area and stop and come up a little bit. Then we'll see. But my opinion is going to come down, come up, and then, and I'll be raising my middle finger to all the people who say gold is always safe. It is not. It is not. Okay. That's the same finger I'm going to raise to people who say buying a house is always safe. It's not true. Okay. It's not true. So write down who's saying what and how you're getting this information. So that's really the only way you can learn. Okay. Because let's call that blue pill. That's blue pill. Okay, so when you get some gray hairs and you lose your money from trading a long while listening to that kind of stuff, and then you get to a point where you go to the charts and you look back in history at other times and you see what actually happened, what factually actually happened, and nobody can tell you anything at that point. That go look and see what happened in the past. Like, oh, this is GLT. I want to see. Actually, this will tell me what this is good enough to make the point I want to make. Now, everybody knows that we had a decline from 2007 to 2009 in the market, right? And what is this? Okay, no, yeah, this is 2009. All right. And this is 2008. So this was the general period when the major market was declining. It's not exact, it's a little offset. But this here shows you that gold was not safe. Let me see if I can put a compare. I'm trying to remember. I'm tired, y'all. Oh, this is why I can't find it. So this is the S&P 500, the main stock market. Let me put this on line chart so they both look the same. Okay, so this is gold. This is the S&P. This is 2007 when the S&P started falling. You see here, gold fell too. It wasn't safe. Now it did recover faster, you know, but it still had a nasty drop also. So there goes the proof. But you'll still hear people believe that, you know, it's not true. You know, and so even when this was rising, look at this. So you really don't. Gold correlates with the dollar. So forget about. I mean, even this move surprised me that the market kept going higher when gold was falling. The market kept going higher even when oil fell. And that was part of my education. You couldn't have told me before 2011 or 2007 in the case of oil. You couldn't have told me that something as important as oil could fall and the S&P 500 would still be going higher. You could not have told me that until I saw it, so that's what happens when you get when your hair turns gray, and you've been around long enough to witness some stuff. Oh, say NUGT. Yeah, I think there's another one called silver. Okay, let me say this about silver. It's the US dollar versus all of the metals. So that's gold, copper, silver, palladium, nickel, all of them. So when the dollar is moving up, all of the metals they are weak, and then when the dollar is falling, the metals go up. And it's the same with oil. Oil is opposite the dollar as well. So oil and metals trade together more or less. They pretty much trade. JNUG. Yeah, there's another one called I'm gonna get rid of this deal, this comparison mode. Let's see. How do I get rid of this crap? Yeah. Wait a minute. Yeah. All right. Turn back the candlestick. And there's, you said, yeah, JNUG. JNUG is in full disclosure, I own this one. I have a decent, forget all this crap I wrote on here. But the point is, that's the bounce. Okay. So it's really just kind of getting started. All right. So, but it's gonna get there. And the opposite of DUST is JNUG. You're right. I saw something on TV that, yeah, I think this is what it was. I'm like, you know how you see something and you go, it kind of flash across the screen and you go, nah, I couldn't have said that. It could not have dropped. I mean, this thing, look at this. The high was 67.90. I'm sorry. 105, I'm sorry. And this is a weekly candlestick. So this is that week starting, I guess, around the 20th, this is the 24th, the week of the 24th of February. Let's go down to the daily. See, if people in my Patreon would have known that, they would have saw that, they would have known. Okay, 105 on the 24th of February. And we're talking about 3 weeks ago. It was 105, and the low today was $11. Oh man. Okay. 10% of $105 is what? $10.50. Okay. So if the current price is around $11 and 10% of 105 is $10.50, we talk about a 90% loss in about 3 weeks. And people think that gold is safe. It's not. Everything goes up and down. You got to learn these correlations. So don't go by what people say. Talk to your financial advisor about that. And make sure your financial advisor is a technical trader. You know. Oh man, yeah, the puts. Yeah, oh God, yeah, yeah. I need to look at that because people. I was watching the video tonight, so people are complaining now that it's not so easy to go into the market and into the options market and just buy puts because it's like a lot of people are hip to it. So the price of the puts is like real inflated because everybody knows the game now. So, but the people who got in and started shorting this early and bought up puts out into the distant future, yeah, they got paid, man. I'm gonna have to do some research to see how much the person got paid that bought, say, expirations that were 2, 3, and 4 weeks out. I mean, they probably sitting on something like 10,000% or 100,000%. Like $1,000 worth of put options is probably like $100,000 right now. It's something crazy like that. You know, man. If anybody's in the doc and clicked on that link, I'll be looking over there soon. Let me finish doing this. Anybody want to hop on and talk about their pain? you know. But yeah. So gold is definitely going through it. But we talking about something being down to $11. This thing ain't gonna keep falling forever. So, or who knows? You know what? Because DUST is really just getting started. No, I think what they're gonna do is what it's called a reverse split, where like zero is so close, and you can't have the stock fall to negative numbers. The thing is already $11. They're gonna probably do a reverse split and offer like 10 shares for your one or something like that to make this low price 110 or maybe 1,000, to give it room to fall. So of course you should know that splits don't increase your the value of the stock. Okay. So if they will reduce the number of shares you have, so that, for example, if you have 10 shares of something that's um, $11, and if they made it 10 to 1, then you'll end up owning like one share of the thing or something. So you don't, when you do the math, when you multiply the number of shares you have, times the price or whatever, you don't end up with more money. You end up with the same money as you had before the split. So don't people think that buying or selling a stock because of a split that is gonna help you make money. So it's just to be ignored. It's mostly just price psychology. They know that people perceive something as being valuable if it's at a certain price. So they play psychological games by making, like if it's a stock that's $1,000 and they know that you're not going to buy it at that price, they want to get more people interested in buying it. They'll make the price be $25, okay, instead of 100, and they'll adjust the share balance that you have to make mathematically the value of what you own will be the same after the split as it was before the split. It'll just create a more attractive looking price, because if something says it's $50 a share, people think it's affordable. But if they see it as $1,000 a share, they'll say that it's not. But if that stock at $50 a share, you will have 20 shares of that. So owning 20 shares of something that's $50 a share is the same as owning one share of something that's $1,000 a share. And so that's what they'll do. So you'll end up, so that's what I think. That a long story, all that to say, I think that's what they're going to end up doing with JNUG, because it's gonna fall off the page. they gotta lift this thing up, give it some room to die. you know, because gold is in trouble. Gold is in trouble. Wait a minute. 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 What is this? This is really weird. Oh, okay. I see what it is now. Because this thing, it started rising. No, no, this is really strange. See, this is why I said these things are risky. No, this thing is strange. Remember I showed on the other. Oh no, no, it's doing it. It's doing it. It had a rise from like 2018, but actually gold, I'm gonna go look at the other one. Gold had a rise from like 20 December of 2015. But this thing didn't rise. It was falling. It went lower. So this really should be, all this should be a rise, but for whatever reason, this particular bearish ETF, it didn't track like it should. So that's why I said these ETFs are weird. So let me go back to I think it's NUGT. I think that's the other one. Okay. All right. So yeah, that one had a rise, but it still should have been rising since like the low in November. Let me show you what I'm talking about. This is why these things are dangerous. They're risky because they don't do what they're supposed to do. Okay, this was the top, and then it fell. Gold fell to, look at the bottom, like Thanksgiving area or Christmas, or December of 2016, and it went higher. So, but when you go look at JNUG, it's supposed to move like this. This bull. So it's supposed to move 3 times. That's the miners. Okay, gotcha. It's not exactly, no, because that's the miners, and that's what I was looking at is gold versus the dollar. So it's not exactly the right. It's not the right index, but they're not supposed to be this far off. Good lord. So yeah. So this supposed to be high. This more recent price level is supposed to be up here, because the difference between the miners and the trend direction of, say, gold versus the dollar, it's not that radically different the way that these things are reflecting here. So that's why I call this a Vegas bet. They are very, very dangerous. You have to watch these things, every day. The slightest little thing that starts to get weird, if it's not going up, like say, let's say if gold falls and this thing doesn't rise like it should. I'm sorry, not this one, the inverse one, DUST. Then you gotta leave these things alone. You gotta leave them alone. Let me see. All right. Let me see what's up. What else I want to talk about? I want to go over a little scan here and see what's been going on. And You know what? No, I don't want to do that. I'm gonna do that in a whole nother video. That's gonna get into too much other stuff. I'll do that probably tomorrow. I want to talk about the bond market. Boring bond market, but it's boring, but it's important. Okay, I'm not no expert on the bonds because I usually deal with stocks and ETFs, but the bond is important because we know that generally speaking, stocks and bonds are kind of opposite. Money will flow. One environment is good for stocks, another one is good for bonds. When we say bonds, it's really like two main categories you need to think of. Okay, this particular fund is the 20-year Treasury Bond ETF. And what that is bonds that were issued 20 or more years ago. And so when these bonds came out, they had an expiration date on them. The interest rate, as the interest rate goes down, those bonds released a long time ago, they go up in value. They go up in value because the interest rate is when the interest rate was higher, that's when these bonds were issued, and bond interest rates generally trend downward, and so as the government issues new bonds at lower interest rates, the fact that those new interest rates have come out and that's lower, those new bonds have come out at lower interest rates, that makes these older bonds that's in circulation in what we call this a secondary market, meaning that you and I are buying from people who bought them earlier. It makes these bonds more attractive because the interest rate is higher on them. So, and this is like money from the government. In fact, you're loaning money to the government. So the government, being reliable, and because if the government will raise the taxes on the citizens to pay you, or America, well, just invade somebody, take their stuff to get your money. You're going to get your money back. All right. All right. So this is the bond bubble that people are talking about. So this thing has been, this ETF hasn't been around forever, but these bonds, these old bonds, 20 and 30-year bonds, have that are in circulation in the secondary market. This old paper, they call it. This old paper has been rising rising in value. The old paper has been rising in value because the interest rate is higher than the new paper. So old paper has a higher interest rate on it than new paper. Okay, all right. So think of it that way. And this old paper with the higher interest rate has been rising since I think like 1981 or something like that. So back in the early 80s, that's how long this trend has been going. So they call this is the bond bubble that everybody's talking about. So when the Fed stepped in to lower the interest rate, that would they lowered the interest rate on the newly issued bonds. So that was an attempt to keep this bubble going, keep this thing moving higher. It didn't work. Okay, it didn't work. So people are the feared bond bubble bursting. It's happening. It's happening. Okay, the bond bubble is bursting, and so this is an ETF that people were buying. That basically investing in the old paper. So that trend, investing in that trend continuing that's been running since 1981. Well, that trend is reversing, okay? And so when this trend reverses, the new paper, okay, the new paper, even with the lower, and they wrap your mind around this. The government is saying, if you loan me money, I'll pay you less interest rate. Okay, and so this particular level, when they lowered the interest rate, this is the 10 year, 20 year, 20 and 30 year. This is the lowest. And this is called the yield. So that means how much you get back, how much the government pays you when you loan them money by taking out buying this bond. Okay, so that yield had reached an all time low, and so although this is a lower interest rate, this yield is rising because people are looking at the decline in the stock market. And although they're not really making much money in this, they're not losing 5, 6, 7, and 10% a day in the stock market. So although the government lowered the interest rate in bonds, it still doesn't. It has not deterred the market. So the new paper money is coming into all of the new paper. Okay, let's see. Let me look at the 10 year. Let's see. It's US 10-year Treasury. US 10-year. Okay. So this is what's scary. Now there are some countries that have negative interest rate. Okay, so let's let's wrap your mind around that. And so we're so low. What's next for us if the government keeps lowering this interest rate? The bond yield will be negative, which means like normally, like if you loan the government money, they pay you interest. But if they make that interest rate negative, you have to wrap your mind around this. You have to pay the government money to loan them money. And so, although we're on the verge of going into negative interest rate, that interest rate is, let's say, if you're losing 1% by loaning the government money, what would you rather do? Lose 7, 8, 9, 10% a day in the stock market, or lose 1% loaning your money to the federal government? So you lose less by loaning money to the federal government than you would by keeping your money in the stock market. So that's what's happening right now, or it looks like that's happening. So everybody's watching this to see if the lower interest rate is no longer a deterrent from people buying this paper. So money is like it looks like it wants to come in here and buy this paper, even with the low interest rate, even with the threat of the interest rate going negative. That's how much the stock market is hated. Okay, and so on one level, you got money coming into these the new paper. Okay, to get the yield on the new paper and treasury bonds. Treasury bonds is a loan from you to the federal government. Municipal bonds is a loan from you to state and local government. A corporate bond is a loan from you to a corporation. Okay, so we are the action is moving from the stock market to the bond yield market. That's where money is going because that area is perceived as safer because the bond yield is at historic lows. And so that's also contributing to the stock market falling like it is because there's so few things you can invest in that's going up. And so money is coming out of the stock market, coming into the bond market on the yield side, not the old paper that we talked about, but the new paper. Okay, and the government uh, sells the paper on a website right here. It's called Treasury Direct. Okay, I'm gonna put that in the chat. So if you're interested, you can buy some bonds directly from federal government on their site, Treasury Direct. And Let's see, there's something else I want. I had a nice article. Here it is. And so this is the significance of the 10-year Treasury yield, okay, and why it matters. I'm going to put this in the chat too for your reading. Try to understand this game so you understand why they're talking about the bond yield and the 10-year in particular, you know. I'm going to just read these quick bullets. Okay, it's just, the Treasury bond is a certificate. And then this is my favorite site, if you already know this, Investopedia. All right, you see any term, any financial term you don't understand, you come to this site and you look it up. Okay, they teach you real well here. I learned this one site is responsible for my knowledge in trading more than any other singular site. Okay, this is the spot. A treasury bond is a certificate representing a loan that's a loan from you to the federal government that matures in more than 10 years. Okay, that's a 10-year. All right. Since they are backed by the U.S. government, they are seen as safe investments, particularly relative to stocks and other securities. We see that right now. Okay. Treasury bond prices and yields move in opposite directions. Okay, so the bond prices, that's the old money. The yield is the new paper with the low interest rate, and they move opposite directions. And we saw that with the TLT ETF. That's the old paper, the bond, and then the TBT, and that's the new paper with the lower interest rate. Okay. Falling prices boost yields, meaning the falling bond prices, like I showed you, that bond bubble bursting, falling bond prices boost yields, and that's the new paper. We saw that one going up. So that's, and rising prices and rising bond prices lower yields, correct. But we're at a bond bubble, so those prices are not going to be rising no time soon. Okay, so we're going to be in that trend of declining bonds and rising yields. We're going to be in that period for a while. And that rising yield is going to push the dollar up, and the whole world, and I really do literally mean that, the whole world is going to buy US Treasury yield and US dollars. And if you think this market was falling fast, you just wait. now that gold is joining the party. You just wait. It's really gonna pick up speed now. This is gonna get really, really ugly. All right. All right. Move treasury bond prices and yields move in opposite directions. Falling prices boost yields, and rising prices lower yields. The 10-year yield is used as a proxy for mortgage rates. Okay, this now we get to take on that other myth dies that houses are always safe. Okay, it's not. They're not. This is why I've been on panels speaking against why we should be concerned about gentrification. Okay, because the gentrifiers are going to lose. They bought these homes at the top of the market, and they are going to get whipped. They're going to get whipped. Shout out to everybody in the urban area who sold their home. Just, I hope you don't go buy another one. Again, this is just my personal opinion. I'm just some YouTuber. Who am I? I'm nobody. Okay, so talk to your financial advisors. But these are just my opinions. Okay, so it's nothing wrong with renting. Okay, and nothing wrong with renting for a couple of years until this market, and guess where it's going, and you'll be able to go right back to your old neighborhood if you want to live there, and the price will be dirt cheap. Okay, all right, because you're going to have all these people upside down in their mortgage, and they're not going to pay it. They're going to walk away from the property, and we're going to have a foreclosure tsunami America has never known. And so it's going to be a home flipper's paradise. Okay. So the home flipping skills. Yeah. Watch those videos. Learn. Don't you flip right now, but learn the game. Okay. Learn the concepts. All right, get your credit together and all that stuff. But there will be a time where you're going to be able to flip property at the beginning of a cycle that, you might be flipping property, not saying maybe 2 years from now, you might be flipping properties in an environment that, you might be flipping for the next decade or more, because you'll be at the beginning of that cycle. All right. A rising yield indicates falling prices, and we talked about that. And falling demand for Treasury bonds, right? Which means investors would rather put their money in higher risk, higher reward investments. A falling yield suggests the opposite, right? Right. Make sure I put this in the chat. Oh, I did put it in there. Told y'all I'm tired. I'm gonna be closing this out soon. Let's see what I can see this week. Let's get a glance of what's been going on this week. Okay. Who lost the most money? Oil. Okay, this is a triple leverage ETF. This is so whenever rate oil goes down, this one I'm sorry, big oil index. Okay, this is an oil company. So whenever amount that oil declines, this thing will decline 3 times, or whatever rate oil moves. On the bullish side. Right. So the fact that oil has gone down, this thing has dropped 3 times that rate. So this is an example of how these leveraged ETFs can destroy you. Okay, you got to know what you're doing. So I just show this for educational purposes, so you can see how the big money traders make a whole lot of money in a short amount of time. But you got to really learn technical analysis in order to capitalize on this. So if you don't join my Patreon, join somebody else's, but do not try this on your own. And you got to get in a learning environment, and you can learn a whole lot faster if you have somebody to guide you. You know, start with somebody who you can understand what they're talking about, and then you'll just basically trade them in, get you a better teacher. It's like any other subject, playing basketball. Your first coach, he's not going to be as good as your second or third one, but they'll get you started. I'm not saying I'm a bad coach. I'm pretty daggone good, but I'm sure there's somebody better somewhere. But he's got to be the man sitting next to the man, sitting next to the man. They call you a piccolo player, you know. All right. So yeah, all this stuff getting destroyed. 80%. This is over the last 5 days. Okay. How is you like that to lose 80%, 85% in 5 days? Okay. Now let's look on the advancer side. See, this is how technical traders roll. This is how we roll. Now, hold on. Sort. Okay, yeah. This is how we roll. Betting against oil, 215% in 5 days. Learn to trade, get your technical game going. Okay. And so when I said I'm kind of nervous every day, because when you own some stuff that's up this amount of money, you don't want to give it back. So now you got to balance your greed. There's a point where you just got to get out and kind of be okay with it continuing to go higher. Okay, so it's a whole different kind of level of stress when you're trying to keep your massive gain, as opposed to licking your wounds after an 80% loss. So it's just to make the point again that not everybody is losing. So it's a whole lot of folks here making 100%, 200%. Yeah. And this is energy. Remember, strong dollar is means weakness in energy and metals. And so this fund goes up when oil goes down. And this one goes up when natural gas goes down. And when the gold miners go down, this one goes up. So same kind of thing. Same concept. Just, somebody's always making money in the market. Let me see. I think I covered everything I wanted to address in this video. And I'm going to take a look and see anybody there. Okay, nope. I got TJM, what's up? Ty City, what's up? James Lewis, what's up? I don't know how to say your name, brother. Alan, how do you pronounce that? A-L-A. I don't know. I guess the G and H would be silent. Darth Patzer, okay. He says, I ain't buying gold until it drops lower than platinum, okay. I wouldn't buy gold until the dollar finishes its uptrend. Okay, I'm gonna have to spend some time on James looking at the put. I may do that tomorrow. Because I need to take a look at it. You right, people are making like absurd amounts of money, but like I said, I saw one video that was saying it was harder to get the good prices because everybody's hip to the game. So many people are trying to buy those puts, so the price gets bid up. Okay, all right. Faber, what's up? Oh, okay. Faber made money on TVIX. Okay, so he must have caught one of my early videos about that. But man, keep your eye on that thing, man. Keep your eye on it. I say don't uh leave some money on the table. Don't try to get the last. That's what I say, because I'm not even gonna try to get the last. At some point, I'm just gonna be happy that I made some money, you know, because I don't want to give it back. Okay, it was too hard getting it, and I'm gonna be okay at the end of say this decline if I'm out of my short position and I just watch the chart and try to set up to get the pop on the other side. I'm okay having no position in the market at all as I get closer to it, but I don't think we're there. I'll be going down on the 5-minute charts and living in that lower level pretty soon here, because I think that we could get something next week, maybe, because we're moving in such big clips. We're going to get where we're going in a hurry. Okay, and like I said, with the painting and tape, and we got to, if not next week, the week after, by the end of the quarter, which is the end of March, we may hit one of those technical levels right at the end of March, and we can end up with a maybe a good April, and then the axiom may be true again. Sell in May and go away, and we may resume the downtrend in May. That might work. But I'll see as it goes. Get my opinion together on that. I'm not real sure. But again, if you want to learn how to trade technically, I would be honored to get you started on the path, man. But until next time, I'm out. Peace.